Gold, new all-time highs. Copper, all-time highs. Oil has reached $90 previously, $100 last year. Stocks we talked about, Bitcoin's new all-time highs. Everything seems richly valued. Is there anything that seems undervalued to you?
You've got to wait for the catalyst to realize that value, and the obvious catalyst is a global cycle upswing. But we're not talking about a global cycle upswing. We're still with central banks battling inflation and still in many places looking to slow the cycle, not accelerate it. So it may be slightly early to buy those markets.
Gerard Minack joins us today. He is a director of Minack Advisors. Is stagflation still a real threat for investors today? And where are the world's best investment opportunities for the medium and long term? Gerard will answer these questions. This episode is sponsored by Brain FM, a very interesting product that offers a productivity boosting tool. We'll talk about that in just a minute. Link down below to learn more. Gerard, good to see you. Thanks for being here. Thanks for being a part of the program.
Thanks, David.
Gerard, let's talking about your overall big picture theme. You're telling me offline. Stagnation, something or stagflation, rather, stagnation in the economy and inflation is a theme that you follow. Is that what we're getting right now?
Well, the story is, for 2 decades, I was a card-carrying secular stagnationist. I thought the world was turning Japanese. We were seeing real and nominal rates trend lower almost everywhere in the developed economies. But I resigned from the club in the pandemic. I think the pandemic was the catalyst for 2 major changes. And the first is policymakers rediscover the joys of fiscal. They used aggressive fiscal stimulus, and I think that's a story that's going to persist. And the second big change is I can see a number of structural secular drivers of higher investment spending in the developed economies. And those drivers include onshoring and friendshoring. It includes higher defence spending. It includes climate mitigation policies. It includes higher public infrastructure spending. What all that means is a number of the most important investment trends of the last 30 years are starting to break down. And arguably the single most important is that trend decline in US interest rates. Of course, there's always wiggles in rates and people can make a living trading those wiggles. But for 4 decades, you saw successively lower lows and lower highs in the US 10-year Treasury yield until 2023, when the 10-year yield broke above 3.5%, and that surpassed the prior peak. So unless you were trading rates in the 70s, I don't think you were, David, that's not something that you've seen in your career before. And although there'll always be ups and downs, I think it's extremely unlikely that the next downswing in yields will take rates anywhere near the 50 basis point low that we saw in 2021. So after 4 decades of lower lows, lower highs, we've made a new higher high. We're going to make a new higher low. And then I think in the next cycle, we make a new higher high again. So in other words, we're in a world of structurally higher nominal, and I also think structurally higher real interest rates. And that is going to have a number of important consequences for us as investors.
Do you think the 10-year yield is returning to its 1980s levels of double digits?
No, I don't think we'll get that high. I'm more thinking that the range will be more like the pre-GFC range, where probably on a cycle average basis, you're talking 4 to 5% as an average. And of course, around that average, you can have movement of 100, 150 basis points either side. So you could see a peak that's got a 6 handle and a trough that's perhaps a 3. That's ultimately the range we're going to head into. I can't see much chance of going a lot higher than that. And that's because I do think central banks in most places will continue to focus on their inflation targets. And it's only if you get a breakdown in that inflation targeting regime where you would see yields go even higher than what I expect.
Before we continue with the interview, let me tell you about today's sponsor, Brain FM. I use Brain FM to help me focus when I'm researching or preparing for interviews, prepping scripts and whatnot. Using music to help with productivity is the only reason I can be consistent with the videos that you're seeing me upload on a daily basis. Backed up by the National Science Foundation, Brain FM's music contains patented brainwave technology, which optimizes your brain patterns for intense and focused performance. You can choose from multiple genres of music, including classical, lo-fi, and even nature sounds. Brain FM even has a mode specifically designed for those who suffer from ADHD. And now you can get a full month of free access by just going to brain.fm/David Lin in the link down below, or scan the QR code here to get Brain FM for free. You have nothing to lose, and if you don't like it after a month, then you can always cancel. Try Brain FM and boost your productivity today. We've talked about the stag part of stagflation. What about the inflation part? So let's segue into inflation now.
Well, I mean, I'm not really talking about stag in any context. I think real growth could be slightly stronger in the next cycle than what we've been used to over the last 15 years. And that's because with higher capex, you add more capex to an economy, you almost always get better productivity. And that means real GDP growth could be slightly higher going forward. And I say only slightly because we do have to battle against demographic headwinds, which all else equal tend to slow growth in developed economies. But net, I'm not at all pessimistic. I can see better real growth ahead. On the inflation side, well, I've got to get my spin right on this. The fact is, if you look at in the US, if you look at Europe, if you look at Japan, central banks missed their inflation targets prior to the pandemic. They were persistently undershooting those targets. So if we get central banks exactly nailing their inflation targets going forward, that would imply slightly higher inflation in the US, significantly higher inflation in Europe, and a lot higher inflation in Japan compared to what we saw pre-pandemic. Of course, they probably won't exactly nail their inflation targets. That's a high task. But I think they'll be roughly close. And I'd be expecting inflation to have a 2 handle on average going forward in most developed economies. So the point here is not that we're facing dramatically higher inflation in a place like the US. The story is really that we need higher real rates to keep inflation at that comfortable zone. So this is much more a rate story than it is an inflation story.
Yeah. And why is it that central banks are going to find it difficult to meet, or have been finding it difficult to meet, their inflation targets? Were there exogenous shocks that were out of their control, where maybe these targets were just too lofty to begin with as an ambition?
A couple of things. I think we need to distinguish what happened in the pandemic. I mean, the pandemic was truly a unique cycle that had special features, and part of the reason the inflation went so high is some of those idiosyncratic, blockages in the supply chains. We saw the lockdowns, which meant that we all went online and bought stuff. There was a huge surge in goods demand, and then obviously when we got unlocked, we went back to spending on services. And what we saw through that phase in all developed economies is consumers swinging spending from goods to services. Now, if you spend $1 less on goods and $1 more on services, that's GDP neutral. But it's absolutely not labour market neutral, because services are a lot more labour intensive. So what we saw was this surge in wage demand that pushed up service prices. So all that really was unique to the pandemic, and central banks have struggled to get on top of that. But looking ahead to the next cycle, the reason why real rates will need to be higher than they were pre-pandemic to keep inflation around target is that we're going to run structurally larger budget deficits, and we're seeing this secular driver of investment. And I mean, we've got to remember what caused secular stagnation. Well, secular stagnation is an economic problem where saving exceeds investment spending. If you look at the data in developed economies, the problem was not that we started to save a lot more over the last 3 decades. The problem was that we invested a lot less. And if you're investing less, that drags down cycle average or neutral interest rates. If we start investing a lot more, for the reasons I said, higher defence spending, climate mitigation, infrastructure, et cetera, then that's going to tend to push up the neutral or cycle average real rate. And that's why real rates are going to have to be higher to accomplish any given level of inflation. So even with inflation roughly around target, we will need higher real rates going forward than what we became used to, particularly after the GFC.
Do you think the economy can withstand higher real rates with the way the deficit is expanding, with the way that the debt levels are rising, both on a sovereign and domestic personal level?
Well, if you look at the US, the private sector has actually been deleveraging over the last 15 years, both the financial sector and the non-financial sector. So they are able to cope with higher rates. And I mean, it's been one of the reasons for the resilience in the US economy over the last 3 years in the face of this Fed hikes. They have been able to cope with it. The public sector, ultimately, I think debt levels in the US are on an unsustainable trajectory, but I'm not sure when that's going to bite. And I don't think it's going to bite anytime soon. And even if it does bite, that doesn't mean we go back to the austerity period that we saw after the GFC. I still think politicians will use fiscal stimulus when there's a cycle downswing, because what the pandemic proved is that sending checks to people in a downturn works as an economic stimulant and is very popular politically. And that's a fairly irresistible combination to most political leaders. So there is a structural issue, but that doesn't mean that you can't use fiscal as a cycle tool to stimulate economies that are in a downturn. And that will make for far more V-shaped recoveries than we've become accustomed to over the last 30-odd years.
Well, the CBO, Congressional Budget Office, has projected that the deficit and debt levels both will continue to rise over the coming decade. As an investor, does this worry you at all? I mean, in other words, does this trend have any direct market impact whatsoever?
Ultimately, it will. But one of the lessons we've learned from Japan, for example, is economies and systems can withstand high public sector debt levels for longer than you would expect. I don't think it's got any significant consequences for growth. I know people keep on quoting to me studies like Reinhardt and Rogoff that suggest high public sector debt levels are bad for growth. I guess I can't think of a study that has got less credibility than Reinhardt and Rogoff. Quite apart from the typos, I think it's a methodological mess. Much better studies suggest that there's no correlation between the level of public sector debt and subsequent GDP growth. But what we are seeing, I think, is the term premium contribute to the rise in Treasury yields because people are concerned about the sustainability. But the other big issue, I think, that could also unsettle bond markets is if there were any concerns about Fed independence. And I think this is one area where the upcoming presidential election is a big deal. I mean, there are areas, obviously, of consensus between Mr. Trump and Mr. Biden. Neither of them will really address the budget deficit outlook. Neither of them will change or dial down tensions with China. But when it comes to Fed independence, I think there is a marked difference. We've had the most aggressive Fed tightening cycle in 4 decades, and yet there's barely been a peep of criticism out of the White House. I don't think that's how Mr. Trump would roll, and it's pretty clear from his campaign that they are looking to curtail Fed independence. Whoever wins in November will have the opportunity to appoint the next Fed chair. It could be Ivanka if Mr. Trump wins. And if we start to think who could possibly put in charge if it compromises Fed independence, and that, I think, would be something that would potentially increase the risks of a Treasury crisis.
This is a quote from Bill Gross. He said that, since we're talking about the election, he says that Trump is the more bearish of the candidates simply because his programs advocate continued tax cuts and more expensive things. He noted that Biden's presidency had also been responsible for trillions of dollars of deficit spending. Do you agree with that analysis?
Broadly, yes. I mean, look, but neither candidate is promising to get the deficit under control. But I think what we're seeing with the Biden program, which obviously had elements of bipartisanship because a number of the bills did get Republican support, is adding to the capital stock. And ultimately, that should help growth. So it is growth boosting, whereas I think we saw with the Trump tax cuts, they added to the deficit in a big way without really adding to growth in any significant way. So it's a poor use of deficit spending. But as I said, I think the big issue that separates the two is not necessarily the size of their deficits. It's the attitude towards Fed independence. And I think the markets would be highly sensitive to any suggestion that the Fed's inflation targeting objectives are compromised. That would be, I think, disastrous for the Treasury market.
I don't know if you read this in the news a few months back. There was a secret document apparently floating around that suggested, well, it was written by some of Trump's supporters, but denied by his closest aides. But anyway, it suggested that if Trump wins, he would have a place on the Federal Reserve Board. He could be an acting governor or even an advisor. Basically, the president would be on the Fed. That was, this proposal. Again, Trump's closest advisors have denied any involvement in drafting this document. Were you aware of this?
No, I did see the rumours. Look, I mean, ultimately, let's see what happens if he does win. I mean, it's an election that's probably too close to call at the moment. But I do think markets will start to focus on this as a risk as election day approaches. And therefore, I think it's wrong to assume that the post-election playbook will be the same as it was after 2016. Of course, coming into the 2016 election, many people thought that Trump being elected would be bad for equities. That's what the pre-election period suggested, because every time he popped up in the polls, the market wobbled. It turned out that equities loved him. This time, I think the most important reaction is not going to be what the S&P does on election day. It's going to be what the 10 and 30-year Treasury yields do on election day. And if they start to worry about the inflation outlook, the outlook for Fed independence, you could get a lift in long end rates following an election of Mr. Trump if he does win. That could easily damp the enthusiasm of equity investors for a new Trump administration. In other words, Mr. Trump could reawaken the bond vigilantes in a way that would be unpleasant for equity investors.
Let's talk about short term, and we talked about your longer term outlook for inflation. Let's talk about your more short term outlook for inflation and what the Fed may do this year. I've been reading from the Financial Times that the shipping rates are resurging during a normally quiet trade period. I know early in the year when the Houthis attacked shipping lanes in the Red Sea, rates spiked. Shipping rates then came down, and now it's resurging all of a sudden. Do you think this has any direct impact on inflation abroad?
I think it's a second order issue. I mean, the nub of the inflation problem for almost every central bank in the developed world is the link between wage growth and service sector inflation. And that's why when it comes to achieving their inflation targets, central banks are so focused on labour market conditions and wage rates. And in the US, wage growth impacts not just core service inflation, but it also over time drives rental costs, which are a huge component of the shelter piece in the CPI. So I think what the Fed will be watching is ongoing signs that the labour market is easing, which it does seem to be doing. It will be hoping that wage growth continues to decelerate. Now, in the March quarter, wage growth as measured by the Employment Cost Index actually lifted at the margin. That would have unsettled the Fed. But if wage growth continues to decelerate and the Q1 number proves to be an aberration, then I think the Fed will gain confidence that inflation will head back towards target. But I don't think that means there's a huge scope for the Fed to ease. I mean, if we do get an easing cycle in a soft landing scenario, I think the best benchmark to look at is the sort of 1995 cycle, where the Fed eased by 3 times 25 basis points, so 75 basis points in total. The problem for the Fed is I think it's completely misreading where neutral rates are. Its long run dot plot sits just over 2.5%. Whereas I look at this setup and I think if a 5.5% Fed fund ceiling leads to a soft landing, there's no way neutral is around 2.5. Neutral is going to be a lot higher. And that means the scope for the Fed to ease, even if we get inflation heading back down towards target, is relatively limited. And I would expect no more than 2 or 3 Fed rate cuts. I think that's possible for this year. If we don't get 2 or 3 rate cuts, it will be because we get less. And if we get fewer rate cuts, then I think the long rates are mispriced, and we'll need to see effectively a bear steepener in long rates through the course of this year, which I think is underway as we speak. Long rates remain under upward pressure.
let's talk about something that our mutual acquaintance David Hay has talked about several times on my show, which is the prospect of a bubble forming in the markets. He's talked about several different bubbles, different over different periods of time. Are we seeing any such bubble right now that you can observe?
Oh, look, I think we've got frothiness around tech for sure. I mean, the analog, I think it's imperfect, but there's some lessons to be drawn from what happened in the late 1990s. I mean, ultimately, the late 1990s saw great companies like Cisco and Microsoft come to prominence. They led that rally. And by and large, they delivered on a lot of the expectations. I mean, Cisco since 2000, has grown its EPS over 10%, 10% compound EPS growth for 30 years. I mean, that's a brilliant performance. The problem is the stock price remains below the levels it got to at the top of that bubble, which just underscores the point. Even great companies can be bad investments if you pay the wrong price. The market today isn't as expensive as it was at the top of the 99-2000 bubble, but it still looks fairly expensive. And I'd be wary that some of these companies, even if they deliver on the hype, are going to be average to mediocre investments given the price they're now trading at. So that's got elements of a bubble to me. Whereas if you look elsewhere in the equity space, particularly non-US equities, there's been virtually no re-rating over the last 10, 15 years, and some of those markets look outright cheap. And that gets to, I guess, my view that in the next cycle, we will see a change in equity market leadership, and some of the frothy areas, which are around tech and AI and concentrated in the US, will underperform, and some of the left behind markets, such as Japan, for example, will be much better relative and absolute performers in the next cycle.
Why Japan in particular? Can you comment more about Japan and what's going on there?
Oh, Japan's got a whole lot of elements that are coming together. First and foremost, it's a structural story. I mean, corporate Japan used to be a lousy allocator of capital. It used to have very low return on assets, but they really have improved over the last 15 years. For the non-financial sector, you've got profit margins near all-time highs. You've got low capex, so that's good. So they're generating a whole lot of cash. Non-financial sector EPS has actually grown faster than the rest of the world over the last 15 years. Now, the market has continued to underperform. So how, on the one hand, do you have better earnings and yet you underperform? Well, it's been derating. And Japan is now trading at a significant valuation discount to the rest of the world. So it's got a structural story. It's got a valuation story. In terms of the geopolitics, friendshoring, onshoring, I think it's in the right spot. But ultimately, my biggest single thematic for the next cycle is blessed are the goods makers. I like companies that make stuff. I like companies that supply the companies that make stuff. And the Japanese market is chock-a-block full of goods makers. So it fits that thematic. So it ticks a whole lot of boxes. Ultimately, if you're looking at the non-financial sector in Japan, even if you are pessimistic on the Japanese economy, and I'm not pessimistic, but even if you are, there's an investment case to be made because a lot of these companies have really disconnected from the domestic Japanese economy. They've got a global footprint. They've got global production facilities. Their success does not depend on the Japanese economy growing fast. So I think it's a lot of things come together, and I think Japan's going to be a terrific market over the next 5 years.
Are there corporate bond and perhaps government bond issues going on right now in Japan, I've been reading?
Well, I mean, the Bank of Japan has been trying to normalise interest rate policy after what's been an extraordinary 20 years of near zero or occasionally negative rates. But we've got to be aware that the Bank of Japan has done an almighty asset swap over the last decade with its massive quantitative easing program. So if you look at the gross debt of the public sector in Japan, it sits at almost 250% of GDP, and that's the number that people will use to scare the children. But the public sector has got a lot of financial assets, so in net terms, the net debt is closer to 150% of GDP. But then if you subtract the Bank of Japan's JGB holdings, you get down to a number that's closer to 30% of GDP. In other words, I don't think Japan has the public sector debt problem that a lot of people think. Effectively, if not legally, but effectively, a lot of it has been monetized. The Bank of Japan has swapped those fixed term coupon paying debts for zero coupon, no maturity paper called cash. And, that's an effective trick that means that the burden of the debt is a lot less than the headline numbers suggest. So, they've pulled a Swifty, they've done it, mission accomplished. And I don't think debt's going to be the issue there that many people do think. Now, for the private sector, we've seen a tremendous deleveraging of the Japanese private corporate sector. I mean, it 20 years ago was amongst the most levered in the world. Now, if you look at on measures like net debt to equity, it's less levered than the rest of the world. And that really is a reflection of those cash flows it's been generating for 2 decades, and it's been paying down that debt.
When we talk about Japan, I think the first thing that comes to people's minds is the lost decade, or actually it's more like lost 2 decades. How do we know that scenario isn't going to play out in the West?
Well, I think I was worried that it may be heading our way, and that was when I said I was in the secular stagnation camp. The reason I don't think it's going to happen here is we're not going to sort of wallow in the low rate, low investment world that Japan did wallow in for 2 decades. And that comes back to more aggressive use of fiscal, and it comes back to those structural drivers of higher investment spending that I alluded to before. And if we have structurally higher investment spending, that means we're not going to have rates that stay as low as they got to in Japan, and we will probably have better productivity growth than what Japan's experienced over the last 20 odd years. So, I think we're going to dodge the bullet, but that's because partly we've recognised that the solution to these secular stagnation forces, and partly some of these almost exogenous reasons to increase investment spending, such as higher defence spending and such as spending to mitigate climate change, which really are almost exogenous shocks that are forcing us to spend more.
Let's talk about investment implications now. So I think you've made, correct me if I'm wrong, but I think you've made the case for being long equities for now, given your view on the economy and how we're not going to get stagnation. But like you said, U.S. equities are richly priced compared to their peers. So, where are the opportunities?
Well, look, it does depend on time horizon. I certainly want people to be long equities if they're taking a 2 or 3 year view. I would be long non-US equities. On a more tactical time horizon, a 6-month time horizon, I think equity markets and risk asset markets generally have priced in a lot of good news, and they've probably got a little ahead of themselves. US equities, for example, are starting to, or have been pricing for the last 6 months with increasing confidence, a cyclical recovery. We've seen a huge outperformance of cyclicals versus defensives. In the credit space, we've seen a huge narrowing of spreads. Now, the problem with that behaviour is in the credit space, default rates continue to go up. And in the economic space, the debate is still about a cyclical downswing, not a cyclical upswing. And although equity markets do look ahead, they don't normally look ahead as far as what the market seems to be doing at the moment. I mean, pricing in a cycle upswing before you've even seen the downswing is way too optimistic. So I think risk assets are now threatened if we don't get an improving macro like the market seems to be expecting, if we don't get falling default rates like the credit space is priced, then we could have these things stumble. And the most likely catalyst for a stumble is exactly the process that we're seeing going on now, a lift in long-end rates. And long-end rates will need to rise if the market reduces its expectations for how far the Fed will ease in this cycle. And there's a very simple point to make about this. At the end of every easing cycle, you always have a positively sloped curve. You always have 10-year yields trading above the Fed fund target. So let's say the Fed eases just 2 times this cycle. So they take the Fed fund rate from a range of 5.25% to 5.5% down to 4.75% to 5%. If at the end of that cycle you need the 10-year yield to be above the Fed fund rate, you're talking about a 10-year yield that's 5% or higher. Now, if we see long end rates head into that territory, I think that's going to put pressure on equities. I'm not trying to make a case for a bear market, but I am making a case for a bit of a stumble, and I would be tactically cautious equities at the moment. So, everybody's got their own risk appetite. So I sort of describe it relatively simply that if on a scale of 0 to 10, 0 is you at your most bearish, 10 is you at your most bullish, and 5 is neutral, I would be around 4. So I would be modestly cautious. And of course, one of the reasons that I'm happy to be modestly cautious is that at long last, being cautious and sticking money in cash will get you a return. So the Tina era, there is no alternative era, is over. You now do have an alternative to risky assets. Cash will give you an okay, not high, but an okay return. And I'd be happy to be overweight cash today and modestly underweight equities.
Would you still stick to a 60-40 portfolio balance?
Well, once again, partly depends on people's risk appetites, but I do think people claiming that the 60-40 portfolio is dead are wrong. What we saw in 2022, 2023, when Treasuries sold off as equities also sold off, was a unique once-in-a-century development. And we know why it was unique. The starting point yield for Treasuries, a 10-year Treasury yield on a yield, 10-year Treasury on a yield of 50 basis points. That's a bond on a PE of 200. So you had a super expensive Treasury market that then got sideswiped, not by a recession risk, but by an inflation surge. It was absolutely diabolical. Historically, even when you have, higher equity bond correlation, which is a world we're heading to, Treasuries have always given you some protection to an equity sell down. So I still think there is virtues in a 60-40 portfolio. I think what happened earlier in this cycle is unique and won't be repeated. But it's also true that the great bond bull market is over. And for 3 decades, bonds did 2 things. They provided you downside risk when equities sold off. But in between the equity sell-offs, they also gave you great returns. So this was like an insurance device where you didn't pay the insurer premium. The insurer paid you premium. It was the best of all worlds. Well, what's going to change going forward is Treasuries will continue to protect you against equity downside risk, but they're not going to give you the same high returns when equities are rallying. And so there will be a greater opportunity cost to holding Treasuries in a 60-40 portfolio. Still will be appropriate to have some Treasuries, but you're not going to get the bull market returns that you saw over the last 4 decades.
TLT, the Treasury 20-year bond ETF, lost about 50% of its value from its highs in 2020. We haven't seen levels this low since I'm looking at the chart, 2012, actually. Is this a good buying opportunity, do you think?
Once again, depends on your time horizon. On a 3 to 6 month time horizon, no, because I can see long end yields going even higher. But once you get to that higher level, then yes, Treasury should do well. They should give you half decent returns, and they certainly will protect you against a sort of a harder landing in the equity space.
This does seem to be a difficult time for asset allocators. Besides Treasuries that I've noted, everything else that I could think of have pretty much gone up. Gold, new all-time highs. Copper, all-time highs. Oil has reached $90, previously $100 last year. It's now come down below that. Stocks we talked about. Bitcoin's new all-time highs. Everything seems richly valued. Is there anything that seems undervalued to you besides Japanese equities?
Well, equities outside the US broadly have not re-rated. They've not re-rated in absolute terms. They're not re-rated relative to their own bond yields. So there's value there, but you've got to wait for the catalyst to realise that value. And the obvious catalyst is a global cycle upswing. But we're not talking about a global cycle upswing. We're still with central banks battling inflation and still in many places looking to slow the cycle, not accelerate it. So it may be slightly early to buy those markets. But no, the fact is not a lot looks cheap. Credit spreads are skinny. Equity valuations in the US are high. They're high in absolute terms. They're high relative to treasuries. Treasury yields, I think, in the near term are more likely to go up than down. Bitcoin is investment rat poison. I wouldn't touch it with a 10-foot pole. The only thing I'd probably be happy to be long is gold. I think gold's got a structural story to it. And if you're bullish gold, then the high beta way to pay that is to be long gold miners, because when gold rises, gold miners tend to rise even faster.
Yeah, let's talk about gold for a minute here. Now, given your current viewpoint on the macro conditions, it doesn't seem like gold has much room to go from here. Do you agree or disagree with that?
I disagree. I mean, I think gold is the ultimate chameleon asset. I mean, it changes its stripes. At some stages, it behaves like it's a currency. At other stages, it behaves like a commodity. At other stages, it behaves like one of those rare risk-free assets that is a financial asset that's not someone else's financial liability. So there's no counterparty risk. When gold behaves like a currency, that's when you see it move inversely correlated to rates, because it's a currency that doesn't have a yield. So if rates on other currencies goes up, it tends to weaken. And that's very much how gold behaved for the 10 years, 12 years after the GFC. But it changed its behavior in early 2022. It stopped behaving like a currency and started to behave like a safe haven asset. What was the reason for that change? Well, Russia invaded Ukraine and the West seized a lot of Russia's FX reserves. And that triggered an ongoing bid for gold as a safe haven asset from the world central banks, as particularly the ones that think they may be at some stage subject to US sanctions, look to diversify their FX reserves. Now, in that context, you need to remember that gold as an asset class is a very, very small asset class. I mean, it's tiny compared to the size of sovereign bond markets and minuscule compared to like public equities or the total bond market. So if you get diversification out of those other public markets, if people shifted 50 basis points of their portfolio from sovereigns into gold, selling those sovereigns would barely be noticeable in the sovereign bond market, but the inflows to gold will make the gold price explode. So I think there's now a structural story to gold as it gains a safe haven bid. In other words, it's broken away from being just treated as a currency. It's changed its stripes, and I can see further gains for gold and further gains for gold miners.
It's not so much a well, you use the word safe haven. It's interesting how you've categorized it as such, because if we have continuing growth in the economies, if we have continued growth in the stock markets, won't people shift into risk assets away from safe havens?
Well, you've got to look at who's doing the buying. I mean, we're not talking about mum and dad investors doing it. I mean, there may be some at the margin. There's certainly reports of retail investors out of China buying some gold.
Right.
We're talking about FX reserve diversification.
I see.
mean, these are not people who stick their money into the SPY futures. They're transferring out of Western world sovereign bonds into gold so that they don't have the counterparty risk and
so I think
can
what you're
escape
saying
sanctions.
is central banks will have more of an impact on the price ultimately than investment demand.
Correct.
Okay, interesting. And finally, I'd like to talk about the dollar. So the DXY has been over the last couple of years quite strong. It broadly mirrors strength of the U.S. economy versus its peers. What's next, do you think?
I'm going to say it again. It will depend on your time horizon. If we are talking, the medium term, 2 or 3 years,
Sure.
What tends to drive a currency on that time horizon is a country's terms of trade. So that's the ratio of export prices to import prices. What's happened to America over the last 8 or 9, 10 years is it's transformed itself from being a net energy importer to a net energy exporter. Initially, courtesy of shale oil. More recently, the massive expansion in its LNG exports. Put simply, that means if energy prices go up, the dollar is likely to go up. So what's your view on energy prices over the medium term? I'm relatively bullish. I think carbon-based energy prices will go up because we're putting roadblocks on the supply side. And it's not clear to me that the transition to alternative fuels is going to happen fast enough to get carbon-based energy prices down on a sort of 2 to 5 year view. So I think the dollar will remain strong, structurally strong over the next cycle. Nearer term, a little bit more nuanced. What we've seen over the last 18 months is a world where the US is persistently surprised to the upside in terms of its macro data, where we've seen downside surprise in a lot of the rest of the world. I mean, Europe's been stagnant, the UK's been in recession, Japan's been weak, and China's been a macro mess. So, we've had this lopsided world of macro surprises to the benefit of the dollar, to the detriment of other major economic blocks. And that's been something that's also assisted the greenback. Going forward, we may see a slight role reversal. I mean, we probably will get slower growth in the US. It's more realistic to think about economic upswing in places like China and Europe because they've gone through a downswing. And that may mean at the margin the dollar is a little softer. But, you've got to get your time horizons right. There may be some pullbacks in the dollar on a sort of 3 to 6 month time horizon. But if you're taking a 2 or 3 year view, I will take those pullbacks as opportunities to buy.
Well, Gerard, I really enjoyed talking to you. Where can we learn more about your work and your views and follow your work?
Well, David, I provide my research to institutional investors only. Unfortunately, I don't provide to retail, but if there are institutional investors on your call, they can get in touch either on Bloomberg or just email info@minackadvisors.com.
Okay.
And I will get back to them.
We'll put a link down in the description below, so make sure to follow Minack Advisors there. Thank you very much, Gerald. We'll talk again soon.
You're welcome, David. Have a good day. Cheers.
And thank you for watching. Don't forget to like and subscribe.